Right, hello everyone. Thanks for joining us today and welcome to this edition of GoalsGetter Live. For those of you who I've not met previously, my name is Sam Belton and I work in the client relationship team here at Nico NZ. Today's guest speaker is Ian Fulton, Portfolio Manager for our Global Shares strategy. Ian is ordinarily based in Edinburgh and he and the rest of the Global Shares team have been with Nico since they joined in 2014. For today's session, we are lucky enough to have Ian here with us in Auckland and available to share his thoughts on markets, what's happened, what's happening, and where to from here. So with introductions out of the way, Ian, we are in your hands for the next 20 minutes or so.
Okay, great. Thanks, Sam, and good afternoon, everyone. I think I can share my screen with a little bit of luck if the technology can allow, and hopefully you can see some slides here. I'll cut to the chase. The elephant in the room, we're in a bear market for equities. And what does that mean? We think it's two things. Number one, we're adjusting to a bit of a change in the economic reality, higher inflation, probably higher inflation for slightly longer than people expect. And that means the cost of money is going up, interest rates are going up, and that's how equities are valued. And that tends to mean that equities come down as the valuations correct a little bit. So we're seeing that, and we might have a little bit more to go through, but that's what bear markets do. They help cleanse the system and we move on to something more productive in the future. The other thing that bear markets do is, they take capital away from the sector that was hot and leading in the previous cycle, and they reallocate that money into new areas and usually something different, and the future winners that are going to drive the next leg of the bull market and take us higher from here. So, what are those future winners and how's that happening and why is that happening? So that's really the topic that I'd like to talk about today. Where are we seeing the potential for these winning businesses to emerge? What industries, what companies, and we'll take a look at that and see if we can draw some conclusions as we go. So yeah, 20 minutes of chatting. I think it's probably helpful to think about the backdrop and how we got here. We've used this slide before, and it really is about the social mood across the world, and that people don't want handouts, they want actual change, and that's true when it comes to the environment, it's true when it comes to social aspects. But as investors, sometimes we're a bit reluctant to embrace change. We think we can identify it and profit from it. But often as investors, we kind of hope that things go back to the way they were. And right now, a lot of people are kind of hoping that inflation's going to peak, and they're hoping that interest rates are going to come down, and they're hoping that all these growth stocks and technology companies are going to lead us back into the future, and we're going to get bailed out of all of that. And unfortunately, it doesn't always work out like that. And change happens and we have new regimes, and we just have to deal with that. So I think there's a little bit of that going on right now, and that's what we'll try and explore as we go through. But some context, a little bit of background. Where were we in 2009? If you remember, the young generation, they wanted to occupy Wall Street and really kind of break the system. The banks had destroyed the fabric of society, if you remember. The economy was collapsing, unemployment was rising rapidly, and they really wanted to do something completely different. And that young generation drove a real groundswell of protest and a desire for that change to be done very quickly. But then we fast forward to last year in 2021, and what were that young generation doing now? Well, my son's a student, and his friends were taking out student loans and buying Bitcoin with the proceeds, and they were trading GameStop on margin on their mobile phones, and some behaviours that were really pretty crazy when you look at it. It's just not a sensible way to invest, and particularly if you're using debt. So some pretty dangerous behaviours, and we've gone from the youth of the day wanting to occupy Wall Street and break the system, and then we'd gone to outright speculation, on margin, and things that were pretty dangerous for your financial health. So how did we get there? Well, the small matter of $21 trillion. The stimulus that was put into the global economy, and that's the kind of economic support the handouts, if you like, in terms of tax cuts and fiscal, to encourage activity, and the interest rate cuts and the money, printing money, basically had the effect of putting $21 trillion of liquidity and cash into the system since 2009. And that's, I just can't even imagine how much money that is. That's an extraordinary amount. And 65% of that $21 trillion was deployed into the global economy in the last 2.5 years during the pandemic. So, what happens to all that money? Well, it finds its way, first of all, into asset prices. And that's exactly what happened in these behaviors of buying Bitcoin. You can see the green and blue charts, the kind of Bitcoin index. The green one is GameStop itself. And as the liquidity was really being generated at its peak, that coincided with these things going absolutely crazy from a price point of view, and almost completely unsustainable in reality. But other asset prices were going up consistently as well. Technology stocks going to 10 or 15 times sales in terms of their valuations, and just all sorts of things. So equities in general as well. We saw 11 years of positive returns in a row from the global equity index, and that's unprecedented pretty much, certainly in my career. So, a lot of that liquidity was driving financial assets higher, and we had financial inflation. But as time goes on, and all of that cash that's swirling around the economy translates into real demand for goods and services, we had these inflationary pressures begin to build in the real world. So commodity prices, whether it's natural gas, or the kind of house prices as well, which we all know from here in New Zealand, went up an awful lot during the pandemic. And that happened around the world, again, driven by that liquidity and people having cash to spend. So this inflation problem that we're dealing with now had started before the war in Ukraine. It's not just about that. And now that poured fuel on the fire, if you like, to pardon the pun, but that's essentially something that was put in place already because of this excess cash that was swirling around in the system. So, what does the future look like? Well, that cash is now being withdrawn. Central banks realize that they need to get that inflation under control. And, we're not going to have the smooth tarmac of central banks putting more cash into the system and making sure that asset prices didn't go down because they wanted to encourage activity and lending and all the recovery that we needed from the financial crisis in 2009. We've gone too far. We've printed too much money. And that money's been trying to cram into different asset prices and also into physical, to buy physical goods. And, we've got an inflation problem. So as we withdraw money from the system and interest rates go up and those conditions tighten, the future looks a lot more like the off-road dirt track than the smooth tarmac that we had in the last 10 years. And you want a different car for that. You could have had the tech stocks with their kind of Formula One type chassis, low to the ground, very expensive, zipping along on that smooth tarmac. They might not run so well on the road that we're headed for in the future. You probably want an off-road vehicle, something that's got really strong cash flows and really good profitability, and probably pays a bit of a dividend and just has that stability that you need to deal with the potholes that are probably going to be coming up on the road ahead. So, this is a bit of a busy slide, but, we try to have a bit more of a statistical look at what happens to leading sectors in each market cycle. So what this chart looks at is essentially, if you take the point where, we've just had a 20% drawdown in equities, so a 20% fall. So if you look back in history, and every time we've had a 20% or more fall, if you take the price low at that point and then go through to the next price high before the next 20% or more fall, we call that one market cycle. Now, back to 1957, we've actually had 11 of those market cycles. So what we looked at was, if you were the winning sector in the previous cycle, like technology was the winning sector over the last 10 years, if you won during that period, what are the chances of you winning in the next period? And the fact is, shown here in the top right, that of those 11 occasions that we had a leadership sector in that market cycle, only twice did that leadership sector actually win in the next cycle. So, you know, you can bet on technology if you want, but history would kind of suggest that, you know, the leadership in the market might come from elsewhere. You know, it's difficult to categorize some of this data. You know, what's a technology company in 1963? Is it Kodak? Is it Xerox? Is it a typewriter company? You know, what is it? But mapping the data as best you can, these are the outcomes that give you that evidence. So only twice out of 11 observations has the leading cycle from the previous the leading sector from the previous cycle won in the future. So we'd be pretty careful around thinking that technology would automatically be the winner and the sector that will lead us out of the difficulties that we're in. And where you do get much more data and many more observations are around you know, individual stocks. And again, if you look back, we've taken periods from 2011 to 2016, a 5-year period, but also the 10-year period from 2011 to 2021. And if you look at those businesses and at the start point, and you look at their return on capital, so the profitability of those businesses, and you take the companies at the start that had a certain level of profitability, and the ones that, you know, the ones that improve that level of profitability over that 10-year period, you know, these are the ones in the dark blue at the top here, and that's the return that you got in the share price from those businesses on average that could show an improving return on capital or an improving level of profitability. And, you know, that's a 507% return. It's a massive outperformance compared with the 381% return from those businesses that just were able to maintain their profitability and their return on capital, you know, on a kind of level playing field. And then again, far outperforming those businesses that were actually seeing their returns decline. So, you know, that's what we think is the critical thing to look for in the companies that you're investing in, is those businesses that over any 5-year or 10-year time frame can actually deliver an improving return on capital, an improving picture of profits along with growth. And these are the things that we have to look for. So if we're looking for that, and then we think about the technology sector, what are the chances of finding an improving return on capital from there? And can tech companies improve their profits going forward? Well, the first thing, you know, to think about, most people just think about the profit that is going to be made and how are these companies going to earn that profit in the future. But it's also important to understand how much capital, how much money has been allocated into the technology sector that you then need to earn that return on. And this is where we're quite concerned. So in the tech sector in 2021, there was $650 billion worth of new funding to tech startup companies. So that's new competition that's coming into the industry to really, you know, try and compete for the returns that are there. And that means that those returns in aggregate will probably begin to be depressed. And that's far in excess of the $200 to $300 billion that were raised on average in the years before that. Not only that, there was about $400 billion worth of IPO, so initial public offerings, so new companies forming in the public market, which adds into that money that was spent on new tech startups in the private equity market. And that means we just had a whole lot of cash poured into the sector to create new businesses, which means the competitive forces within the industry really take a move up significantly. And that tends to mean that the overall profitability will come down because it's just more competitive. So we tried to look at some of the detail of this and what does that mean for some of the listed businesses today. And really, it's most noticeable when you think about the advertising market and the trouble that Alphabet and Meta platforms are having right now. So if we took that $650 billion of total startup funding from the private market and we figure out, well, how's it going to be spent? What do these companies do over the next 3 years with that? We think about 60% of it, $390 billion, would be spent on the kind of operating expenses of the business. So wages and things like cloud infrastructure, the kit you need to operate your business is probably what that money is going to be spent on. And obviously you need an office in most cases, and they'll spend some money on rents and other expenses. So about $390 billion on running your company and making sure you've got the assets to help it to operate in the longer term. But then the rest and the stuff that's left over, so about $260 billion, really goes into acquiring new customers and trying to grow your pipeline of people who are using your goods and services, and really helping that company to grow the top line over time. So about $260 billion spent on digital marketing and customer acquisition. And that flows almost directly into the P&L, the profit and loss account for Meta Platforms and for Alphabet. Now, that's about $130 billion each, we estimate, in terms of demand that was being generated from these new private equity businesses starting up. And the point about this is that in today's environment, with cash much less available and liquidity not being put into the system, cash being withdrawn, a lot of that funding is going to dry up and it's not going to repeat. And if it doesn't repeat, that means that this $130 billion of demand that was coming through for Meta Platforms and for Alphabet is actually going to go away. And that's a major headwind for the revenue projections for these businesses. Coincidentally, Alphabet's forecast to grow by $120 billion on its revenue line between 2021 and 2024. We just think that's a major challenge, and really struggle to see, with this degree of headwind, what companies in the advertising market are going to pick up that slack. So we're very nervous about the outlook for profitability and for the top line growth in these areas in the kind of near to medium term. Long term, they're still great businesses, but it doesn't feel like the thing that's going to lead us out of the bear market and cause us to get to something more exciting on the other side. So what will? Well, we worry a lot about emissions. We talk a lot about emissions, and we used this slide before in some of our presentations, and it's all about the targets that we need to get to reach a 1.5 degree global warming world. And as we know, we are way short of that right now. And we estimate that the world spends about $1 trillion on emission reduction and alternative energy systems right now. And the belief that that move into decarbonisation and renewables, we probably need to spend $3 to $4 trillion by 2030 to get close to our targets. Now, we've improved the gap from COP26 that happened last year, but only improved it by about 15 to 17% in that time frame. So we need to do more. We need to do a lot more, and we need to spend a lot more money in tackling the issues that are going to cause these emissions to come down, and so that we can hit the targets. And we think these are the big issues that are facing society and could characterize the big things that we need to solve for the next economic cycle. Now, what companies could stand to benefit from that? Well, we're very excited about companies that are involved in energy transition. So the movement away from fossil fuels towards wind and solar, and then that wind and solar network being connected to hydrogen to allow us to store that variable power source and then use it, when we need it, where we need it, and much more effectively and efficiently than we do today. And if you're sitting in Europe and at the moment you're headed into winter, you're reliant on Russian oil and gas imports, and you really don't have any choice about where that comes from, and the price you're paying is absolutely extortionate, then I think you've got a huge incentive not only to build that energy alternative network based on an emissions point of view and hitting our emissions targets, but also from an energy security point of view. Europe needs an alternative to Russian oil and gas, and we think that movement towards more wind, more solar, and linking that wind and solar to produce green hydrogen is very much the future way that Europe will begin to go. And we think the companies that are listed here, which actually form about 15% of our overall portfolio, they're very attractive. Solar Edge manufactures inverters, which are used at the edge of the solar farm installations that we see going up around the world, and they earn a 15% return on capital. We think it's going to grow and improve over time. KBR and Jacobs Engineering and Worley in Australia, they have large businesses in engineering consulting, consulting on these sustainable solutions and these infrastructure projects that are going to get built to make us these large-scale wind farms, the large-scale solar farms, and the hydrogen infrastructure that we need to build that network out of alternatives. So we think these companies have got great growth prospects. You should be able to show improving returns on capital, and that's exactly what drives outperformance. And we think this could be the leading area in the next cycle, just as technology has been in the previous cycle. The left-hand chart here shows why we don't own oil and gas companies. They're good businesses when you're going from that 2% return on capital you can see on the left to an 8 to 9% that they would earn at the peak of the cycle. And you can do that. But what typically happens when you get to that 8 or 9% is that you either get demand destruction because oil prices are too high, or you get a supply response, and we will have alternative energy networks which are appearing, but we'll also have drilling for oil and gas, which will be going on to expand supply over time. So we tend not to buy the straight commodity players. We would much rather buy the companies that are on the right-hand side of this chart that will help solve these problems, but while also earning really good levels of profitability that help us to deliver that kind of sustainable, stable return with less volatility than some of these cyclical oil and gas companies on the left. The other sector that we think could be a kind of leadership contender in the next cycle, is really around healthcare. The demographic profile of society, in terms of how we're all aging, is a significant issue. The labour force is actually shrinking now as people retire, and that cohort of people in need of good quality healthcare continues to grow. But the problem that we have as society is that the amount of debt that's been put into the system just means that it's becoming very difficult to afford that high quality healthcare that we need. The amount as a percentage of GDP that healthcare makes up in the US is absolutely enormous. So thinking that a drug company that discovers a new product can just put drug pricing up and collect that return as they have done in the past is probably yesterday's thinking. We need businesses that can really innovate and can produce the new quality drugs and types of care from a lower cost setting and a lower overall cost to the economy and to the consumer, but deliver better healthcare outcomes as well. So we need a lot of innovation in this area. So we're invested in the companies that enable that sell the kits, they sell the machines and the products to enable new drug discovery. And companies like Danaher and Biotechne have been very successful for us over a long period, and we think the future for them looks just as rosy. So again, healthcare we think is quite an interesting spot to think about. I wouldn't be a fund manager if we didn't give you an individual stock name to think about. People often say to us, well, you're a long only 40 stock portfolio. There's inflation, there's a recession coming, everything's going to be going down, and how can you find companies that are thriving in that type of environment? Well, the very challenges of the environment are what's driving faster growth at Compass Group at the moment. Now Compass is a food service outsourcing business. So if you have a food offering in a sports stadium, typically Compass will be the operator of that food offering rather than the soccer or rugby club that you have there. Often in hospitals and in universities as well, they are the operator of the food offering within that. And what's happening because of the tightness of labour markets and food price inflation, hospitals and universities in particular, they don't need the headache of managing that kind of challenge of attracting and retaining labour and making interesting and valuable, nice menus for their customers and their patients in the face of rising food costs and inflation on that front. So the rate of new business outsourcing to Compass in the US is running at double the rate that it ever has in the past. And we're seeing about 6% net new business growth, plus the pricing power that they have in existing contracts. And yes, there's a little bit of margin pressure because of that tightness in the labour market and food price inflation, but because of their scale, they're able to manage that and work their way through. And this is a business that was really hit very hard in the pandemic. The profitability went from 20% down to 10% because the business was closed for much of it. But that's now recovering quite sharply and moving up towards 15% now, and we think actually can get back towards 20% over time. And that's exactly the type of business that we look for. This is a company that also did exceptionally well in a recession. In 2009, it continued to grow its revenue and profits because, again, as things become more challenging, businesses outsource more, and particularly these non-core, slightly peripheral areas like food service. So we think it's a great opportunity, a very sensible valuation, and just kind of fits all the criteria that we're looking for in a long-term holding within the fund. It's actually our biggest active position in the portfolio today. So we'll wrap up. I think we're roughly on time, hopefully, but we do think we've got a change in the market. There's a regime change as we adjust to higher rates of inflation over the medium to longer term, and that's kind of the new normal. The good news is I think the markets are adjusting to that, and we shouldn't get too bearish. The banking systems are in very good shape, much better than they were in 2009. So as we adjust to that, slightly more awareness of longer term inflation being slightly higher, then that should allow markets to settle down, and we can begin to look for more positives from here. But those positives will probably be accompanied by new leaders. And we've talked about the healthcare sector. We've talked about energy transition companies that we think are likely to feature at the top of the charts in the next cycle, we hope. And it might be a bit far-fetched to think that technology will lead us in the next cycle again. So that's that. We won't change our philosophy. We need to look for long-term drivers of outperformance and long-term drivers of improving returns on capital. And yeah, we've tried to explore some of that in today's session. So well, thank you for your support and your attention. And I think Sam's maybe going to open it up to see if we've got any questions.
Yeah, thanks, Ian. We just have one question come in. HelloFresh, you held in the portfolio until earlier this year. You took it out. Can you just talk through the process to take that out and perhaps where you reinvested that capital?
Yeah, sure. Thanks, Sam. It's always good to get a challenging one. Yeah, HelloFresh was a great stock for us in 2021. We bought it kind of mid-2020, and obviously as the pandemic had pulled forward demand for meal kit solutions and delivery at home, they saw a rapid increase and a real nice improvement in profitability. The profitability went to about 15% with really rapid top line growth, and the shares more than doubled. So at the end of last year, at about 80 euros, we took our position in half. So we took it from 3% of the fund to 1.5. And then, of course, things happened from a food inflation and from an energy cost point of view as 2022 has kind of rolled on. And that brought a lot of pressure on the share price of HelloFresh and a lot of pressure on the margins for HelloFresh as well. So the share price halved. It went from 80 to 40. And we were re-reviewing that along the way. And our analyst, Ellie, she looked at that and felt that actually with further increase in costs and the further investments that management were making in their asset base for last mile delivery, the return on capital, the profitability was likely to fall further because they weren't willing to pass on those price increases to consumers. They still want to grow the category, which long term is probably the right thing to do. But likely that in the near term, it's that those profits would continue to decline, and that would be pretty challenging. So we elected to sell at 40, and we disposed of our entire position. So it cost us about 0.6% in terms of performance this year. The good news, though, was that we reinvested into a company called Carlisle companies in the US, and they focus on sustainable solutions for roofing, the roofing market in the US. And as regulations are tightening in the US, we're seeing a huge acceleration in demand for these roofing solutions that really reduce the carbon footprint of the building that they're attached to. So for new buildings, but also for existing buildings being retrofit. Even these little kind of gardens that you see on the roofs of buildings around the place. So Carlisle do a lot of systems and drainage and kit for that. It means your building won't be undermined if you've got one of those on the top. So that share price actually went up 40%. So the lesson from this is if you've got a loser, and we always do, there's always something that's not working. If you've got a loser in your portfolio, don't be stubborn and hang on, even though the fundamentals are still deteriorating. Quite often it's not always in the price. HelloFresh actually continued to deteriorate and went to about 25 euros. So we're absolutely delighted that we made the decision to move, from $40 of HelloFresh and actually got a 40% return with that capital that we reallocated. So quite often, taking your losses, if you've got a better idea on the other side, can definitely be the right thing to do.
Thanks, Ian. That's perfect. And that brings us right up to our close time. So thanks very much for your time today, for joining us, and thanks to all attendees for joining as well. We look forward to seeing you again soon.
Thanks, everyone.